We're joined now by another market watcher who says there are cracks beneath the surface of investor optimism. Of course, stocks in America and Canada at or near record highs. What are his key concerns? We're joined by Garrett Melson, portfolio strategist with Natixis Investment Managers Solutions. Thanks very much indeed for joining us.
Thanks for having me.
The stock market essentially at record highs. Do you think there's too much optimism, even euphoria?
Yeah, I think the reasons for the pretty stunning rally off the April lows are pretty simple. Obviously, you had a pretty meaningful fundamental pivot from the Trump administration, but that simply gave way to a broad swath of investors that had de-risked, needed to scramble to get back on side, namely institutions and a lot of the systematic strategies, and put that together with a really improving fundamental backdrop from a corporate earnings perspective. And you have all the firepower to really push up to all-time highs. I think the concern right now is not so much that those fundamentals are shaky over the longer run, but in the near term, I think the consensus narrative might be getting a little bit over exuberant in terms of the durability of the strength in the U.S. economy here. From our perspective, I think there are still some near-term risks, specifically with respect to the labor markets, that a cut or two don't necessarily rectify coming from the Fed here. So I do think that there's some scope for the markets to potentially have to grapple with some signs of slowing growth, but ultimately I think that's a fairly short-lived and a fairly shallow pullback that, in our opinion, is certainly a viable opportunity to lean into risk, lean into overweight equities, and lean in towards those cyclical areas of the market as we look into next year.
Capital expenditures by companies, a crucial driver of the economy. They have multiplier effects, etc. But you say beyond AI, it looks anemic right now?
Yeah, it's an interesting dynamic that's emerged. We've kind of been cautioning for our clients that the breadth of economic growth here in the U.S. has been narrowing over the last couple of quarters. And now when you look at it, over the first half of this year, you've actually seen a stronger contribution coming from AI investment, which is only about 5 or 6% of GDP, versus the consumer, which has only added about 70 basis points to growth, and that's 70% of the economy. So a really interesting dichotomy that's emerged this year. But outside of AI, you're really not seeing a whole lot of contribution. Non-AI investment has been anemic for the last 3 quarters, basically oscillating around contraction or flat for a couple of quarters here. And so it really does boil down to the AI spend being one of the lone pillars that's really supporting growth in the U.S. at the moment.
What about the labor market? We've heard a lot about an unbalanced stock market dominated by the tech stocks. You're seeing uneven patterns in the labor market too?
Yes, I think it's really a story of this continued cooling in the labor market that's been underway for, going on well over a year at this point. It's more of a linear cooling right now, but I think the concern, and this is certainly echoed by Chair Powell's comments at Jackson Hole, I think Governor Waller, also kind of at the leading edge of the Fed's rhetoric, have cautioned that whilst labor supply has fallen, you've also seen a notable downshift in labor demand, and that just simply means that your downside risks are growing here. So I think the Fed is certainly on the watch for, and I think investors need to be on the watch for, that linear cooling potentially starting to morph into something that's a little bit more nonlinear in nature. And that's where, some of the concerns lie. Again, I think there are some easy solutions to this. Rate cuts might not fix that immediately, but moving back towards a neutral policy stance can certainly be helpful, if not just from a cost of capital perspective, but also from a signaling perspective to help stabilize, sentiment. But in the near term, I do think that there are some downside risks that you continue to see that weakening playing out in a lot of the labor market statistics.
Is there any sense, or do you get any sense that we're in a tech bubble right now? We have this massive spending, hundreds of billions of dollars apparently, on AI server farms, companies investing heavily, but we've yet to see a surge in profits from AI.
Yeah, it's obviously a common theme and refrain and concern that we've heard from a lot of our clients now going on a couple of years at this point. But, time and time again, we see quarterly results come in that this AI CapEx investment boom really is not over yet. And I think the key to really compare to, what a lot of people are looking to the dot-com bubble is the fact that these investments are not being done by smaller companies, and their clients aren't small companies either. These are really the biggest companies on the global scale. Their clients are big companies as well. And a lot of these investments are not being funded by debt. They're rather being funded by cash flow. So the concerns about a bubble, I think, are a little bit overdone. Is it sustainable over the long run? Probably not. At a certain point, you'll see that CapEx boom start to peter out. And we do need to see signs of some profitability and some actual use cases here. But I think at the margin, you are starting to see that play through. It probably will take longer than investors think. But at the end of the day, I don't think there's a lot of comparisons to draw to the dot-com bubble here. These are certainly very different companies that are far more profitable and funding this out of cash flows.
I thought we lost you there for a second, Garrett. What about US 10-year bonds? If you were to buy them today, do you think you'll have made money in 5 years? Would it be a profitable trade? I know that's a tough call with so many variables.
Sure, 5 years is certainly a longer time horizon, but I think what's unique about the current environment is we're finally getting a pretty attractive carry, as you move out the curve here. You don't have to even move that aggressively out the curve to get a pretty healthy coupon in here. So I think as a tactical perspective, I think there's some opportunity for some capital appreciation, in the sense that you do see the market have to grapple with some of these growth concerns. I think that's going to manifest in a move lower across the curve and certainly at the 10-year tenor. But over a longer time horizon here, I think it is largely a story about carry. And 4% carry in nominal terms with maybe a little bit of incremental room for some capital appreciation in the near term is a pretty attractive backdrop, especially when you consider that in real terms.
Garrett, thank you very much indeed for joining us.
Thank you for having me.
Garrett Melson, portfolio strategist at Natixis Investment Managers Solutions.